Hey folks, it's Dave Burrows. Welcome to Barometer's Tuesday afternoon Barometer Readings webcast. We're now working our way into the middle of February. We're about a month past the US administration's inauguration. There's been all kinds of news flow on tariffs in various places around the world in various industries. Some good news and some bad news. We are more than halfway through the S&P 500's earnings season. So there's been no shortage of things to think about. The market has been doing some sorting. And as usual, what I want to do today is just kind of talk through from the top down what we're seeing going on. It's always interesting and important to be on top of what the news is. But I would argue in general, it's more important to understand how the market's reacting to news or how the market is absorbing news so that we can continue to understand how resilient the market is. And we have to remember that the market is like a giant machine. There's 1,000 moving parts. There's some big obvious things that we read about every day in the paper that have an impact, but there's lots of things underneath the surface. And it's why sometimes when there's bad news, the market doesn't react that much. And that's always a good sign for the internal resilience of the market. Let's just start from the top as we always do. I'm going to work through the asset classes quickly. We believe we're in a bull market. We've been in one since 2013. The S&P made its first new high in January of last year after rolling over in December of 2022. So that was a typical cyclical bear market. Cyclical bull markets within a long-term secular bull market tend to last anywhere from 2 to 5 years in between corrections. We're a year and change in, and the market has been very resilient. When we look at the S&P 500 under a microscope, the low back in here, October of 22, you can see the market made a high in the middle of December and has basically been chopping sideways since then. And there have been some parts of the market that have been better and some that have been worse. But in general, the old saying is, don't short a quiet market. When the market is going through a sorting process or a consolidation, the market's working through news. The fact that we are sitting within a whisper of all-time highs, given the news flow, I think is pretty encouraging overall. Now, historically, when you have the inauguration, there's a period of time where news is going to flow into the market. We're going to see the direction of the administration's efforts. The market has a chance to digest that. And then generally the market works its way higher. We know that when we work our way out, February on average, 54% positive. However, March, 65% positive. April, 70% positive. May, 60% positive. We're into a string of good months as we get through this. So there's a lot of people who worry about, is the market going through some kind of topping phase? And a lot has to do with, the future success of the market. Earnings are one of them. Of course, there are geopolitical issues that we have to think about. But we have to make sure that we don't let our personal views get in the way of where we think things are going. The NASDAQ has underperformed the S&P so far year to date, but also just kind of in this consolidation range. But I want to highlight, we're above the 200-day moving average. We're above the 50-day moving average. We're above the 8 and the 21-day moving average. We're not that far from all-time highs. And again, markets consolidate. Like the NASDAQ did between kind of July and September, we consolidated in this range and ultimately came out and worked our way higher. So we'll see. But we want to know what's happening underneath the surface. In the TSX, it's more or less the same. This is 1, 2, 3, 4 months where we've been bumping up again against these highs. We've seen no lower low. So we have to give the balance of evidence to the market. So whether we're looking at the TSX, which really only just started a new bull market in 2020 after many years of sideways chop, or we're looking at the S&P that's been working its way higher for over a decade, there's some things to be pretty pretty interested in. Now, so far over the course of the earnings period, financials have had a significant impact on earnings growth. So it shouldn't surprise us that the financials have been performing as well as they've been. Moving on to the bond market, we saw significant low in yields in 2020, and we've been making higher highs and higher lows ever since. So what does that mean? It means if you're a bond investor and interest rates are going higher, bond prices are headed lower. And they continue to be in a bear market that started in 2020. Now, yes, we're getting paid a coupon, but if you're losing capital value, it offsets the coupon and doesn't wind up with much by way of return. So as a result, we sort of stayed away from fixed income, especially because historically after the first wave of inflation and a moderation, there tends to be a second wave. And it's been our observation that the sectors that have been performing well are sectors that tend to be a pretty good hedge against inflation, which means smart money has been moving its way into parts of the market that actually benefit from inflation. And when I look at the University of Michigan expected change in prices during the next year, well, we've been moving higher, and tomorrow we're going to get CPI data. My guess is it probably comes in a little bit warm. So when we compare stocks versus bonds, stocks continue to outperform on a relative basis. Stocks are our preferred asset class across portfolios. When we're looking from a dividend investor's perspective, dividend growth stocks, as we look at the RDVY ETF, which is a dividend growth ETF, or frankly, if we look at our high income or tactical income portfolio, which is invested in dividend growth stocks, significantly outperforming the bond market, frankly, doing better than stocks in general. When we get to commodities, this tells the same story. We had a first wave of inflation starting in 2020. We had a global tightening cycle. And look at over the last 6 months, 1, 2, 3, 4, 5, 6 months, where commodity prices have started moving up again since the Fed and other central banks were done tightening rates. This is the market saying it may well be that inflation is stickier than what you would think. When I look at the year-to-date basis across all of the commodities, it's a mixed bag, but almost every one of them is positive. When we look at the S&P, the S&P is up 2%, copper's up 17%, platinum, natural gas 13%, silver up 11%, gold up 10%. So inflationary assets continue to perform very well. Now gold is one we've talked about for a while now. It's been a wonderful asset over the last year. It continues to be. We're currently 42% above the rising 200-week moving average. Gold has been about the best performing major asset over the last year. When we compare it to what happened in the last bull market after a bear market, each one of the legs got to sort of 80 or 85% above the 200-week. We're 40% above the 200-week moving average. My guess is there's a long way this can go. Copper prices, after bouncing off support at the long-term moving average, have been moving smartly higher so far year to date. And that's not atypical of what happens when the PMI data starts to get better. That's industrial manufacturing activity. Tends to be that copper starts to behave better. And this is the various measures of PMI data, which you can see over the last couple of months have started to hook higher. Makes sense. Copper might be doing a little better. So commodities relative to bonds tell us that the hedge that we want to have in portfolios is to inflation, not to disinflation. And so we continue to be focused on equities and commodities, and we have a very, very low weight in fixed income. Commodities relative to the equal weight S&P actually over the last 5 months outperforming stocks. So not a popular asset class, but one that we don't want to ignore. So the US dollar, I think, is an important linchpin. We continue to talk about it each time on relative strength when it's become overbought above this band. It had a little correction, a bigger one, of course, in 2022. And recently we got to overbought. And over the last 4 or 5 weeks, US dollars backing off versus the basket of world currencies. My guess is ultimately this winds up being supportive to things like global stocks and commodity prices. Interestingly enough, the aggregate position of investors in US dollars got to an extreme 4 weeks ago and is still very broadly owned. So it's possible that this positioning can become a little bit less exposed and less extreme. So we don't have to be everywhere. We always like to say our job is to find leadership in the market, the things that are being revalued favorably. That can be asset classes or geographic regions or sectors or themes. We always are looking for change, new leadership to emerge or old leadership to start pulling back so we can make sure we keep our portfolios sort of in tune with what's going on in the market. In a quiet market, when there's not lots going on, sometimes it means you sit on your hands. And if there's no leadership, maybe you sit on a little bit of cash. So our job is to be tactical and pick our spots. Ideally, we are looking for parts of the market that are seeing expanding breadth, where over a period of time, more and more securities in that neighborhood perform well. That's a healthy market. There's no bear markets ever happen while breadth is expanding. And similarly, we want to recognize when things start to turn over. So in our top-down work, which is looking at sectors and asset classes, we're to take all of the groups that we could focus in and try and identify those that are seeing expanding breadth. Those are the areas of leadership we want to focus our attention on. 30% of return comes at the hands of finding the right securities. Those are securities that have something changing for the better, where we can get a not only earnings growth, but multiple expansion, where investors are prepared to pay a higher multiple of earnings. And we're looking for a combination of income statement and balance sheet factors, things that point to acceleration, and price of securities. In other words, are they technically strong? Are they performing well on a relative basis versus their peers? And out of a big number of securities, over 60,000 we look at, we're looking for a few that meet those tests. And we can find securities that meet our tests in parts of the market that are seeing expanding breadth. Well, that's where our portfolio is going to live. Of course, the last thing is we got to be able to carve these out when they stop working. And so having a disciplined selling process is important. And I think most people know we run stops on all of our positions. When we see deterioration in breadth, a group starts to see money flow out, means we stop putting any new money to work, it means we raise a little cash. And to the extent new money comes in, no new money goes into that bucket. So tactically over time, the portfolios are going to shift. Sometimes when we get into a market with clear leadership, it can go on for a long time. So as we sit, and I think somebody has put the wrong chart in here. This is from a couple of weeks ago. Okay, so our short-term indicators, percent of stocks above the 50-day moving average is broadly positive. Percent of stocks with positive weekly momentum has been expanding. Percent of stocks making new highs versus new lows, I know this week was stronger, and percent of stocks trading above the 150-day moving average is stronger. Percent of stocks in uptrends globally has backed off a little bit. In the NYSE, this should read green. I'm sorry, I should have taken a look at it before this presentation. But the short-term indicators for US and the short-term indicators for Canada are positive, and things in generally have been improving. Let's look at leadership for a moment. This is the XLF, the Financial Services ETF, including banks, insurance companies, fintech, credit cards. Relative strength here on the bottom has been steadily rising. Now, since the bottom of the market in 2022, XLF made a new high 3 days ago. If we look at it on a leadership basis, JP Morgan, which is one of our very biggest positions in the firm, I think is number 3, just continues to march along. Well, there's a lot to like. We're expecting to see some deregulation. We're expected to see a lot of deal flow this year, lots of IPOs, mergers and acquisitions. And we're expecting to see the banks have a wider net interest margin, the difference between what they pay on deposit and what they can earn on loans. So JP Morgan trading better than 90% of the companies in the S&P. The European financials, frankly, are behaving extremely well also. I've seen a big tip higher in relative strength, and we're making relative strength highs and absolute new highs. But just keep in mind, this is still relatively early. Financial sector was in a bear market from 2008 to 2021. And after an initial lift and consolidation, they've been marching their way higher since the late part of 2023. And we don't see any change in sight. Industrials continue to be above all the moving averages. Like many other parts of the market, they've consolidated over the last 7 or 8 weeks. The energy stocks still sort of consolidating, but there are pockets of strength. Natural gas is one of them. We've talked a little bit about ARC Resources, reported just dynamite earnings. Suncor, a very, very strong quarter, plans to return a lot of capital to stakeholders. Closed today, I think, at a new all-time high. Materials, like copper, when we came back down and tested the moving average in December, bounced off there. Copper's now up 17% over the course of the start of the year. And the gold stocks just really are leading. Relative strength across the whole group, whether we're looking at the big cash flow generators like Kinross or Agnico Eagle, or the earlier stage companies like Alamos Gold, making relative strength and absolute new highs every day. I just want to keep in mind, though, these can go a long way. In the last bull market, Agnico twice got to 165% above the rising 200-week moving average. It's currently right now at 80% above the rising 200-week moving average, and it's really just inflecting higher. So again, this can go on for a long time. So sometimes we have to focus on parts of the market that are less obvious and less well-liked. Obviously technology has been a great place to be over the last few years, but it's not leading the market currently. Gold equities have not been this cheap on a price to net asset value basis in a very, very long time. And we're seeing the cash flows pick up sharply, and that's based on estimates at $2,600 gold. It's close to $3,000. The uranium stocks look like they're starting to wake up again, and that's after its long slumber from 2007 through 2022. And on the energy front, jumping back, the energy infrastructure companies continue to perform well, relative strength picking up nicely. So communications have been a group that have been leading for quite a while, and there's a good story here. Obviously, communications involves telecom not so good, but the big platform communications companies have been dynamite. We were talking this morning about Meta. Meta, as of the close today, was up 17 days in a row. That's the longest string of gains for any NASDAQ 100 company going back to 1984. AI is really starting to kick in to this platform. And they are one of the most obvious companies to benefit from the changes that are taking place in understanding their customer base. Netflix is another. So these are particularly strong. The tech sector continues to sort of wane, although there's good and bad. Cybersecurity is strong. Software is strong. Semiconductors continue to be weak. We spent some time talking about this week. So far, year to date, the Mag 7 is up 0.39 of 1%. The S&P equal weight's up 3, S&P itself up 3, NASDAQ NASDAQ 100 up 3.5%. But look at what's happening internally. The earnings growth contribution coming from the Mag 7 is contracting, and the rest of the S&P is expanding. We talked about that through the summer of last year. We expect this year the contribution from the rest of the S&P to continue to pick up, and we've seen especially financials are contributing this quarter. And so there's no surprise that there is some outperformance by some other groups. Consumer stocks have been mixed. They've been strong since July. They backed off a little bit this week. Costco and Amazon continue to be quite strong. Ralph Lauren is a newer position that we've added. So some of the consumer branded companies are acting pretty well, and travel and leisure in general seeing rising strength. On the other hand, home construction has been weak, and certainly the autos, including the electric cars, have been particularly weak. Look what happened to Tesla. Tesla's pulled back from just around $500 a share to $320 a share since December. There's some trouble here. GM and Ford aren't looking a whole lot better. The defensive sectors continue to be pretty weak. So the reason I harp on these all the time is because when we see a big pickup in return relative to the rest of the market, it may be that the rest of the market's getting ready to correct. But when we look at utilities and when we look at the REITs, they continue to be relative underperformers. But we always watch because that could be a precursor to a change in the bond market. But weak bonds and weak defensives don't tend to point to a correcting market. They tend to point to a market where there's risk acceptance, or people willing to put money to work. So over the past week, breadth was expanding. We went from the average sector having 39% of stocks in uptrends to almost 42%. We continue to see the strongest sectors, the ones with the highest percent of stocks in uptrends, dominate financials. But we also have some consumer stocks, we have some communications, and then at the weak end of the spectrum, there's a mixed bag, but a lot of consumer staples. If we just look at it in really simple terms year to date, strongest groups in the market: gold, materials, energy infrastructure, financials, communications, dividend growth as a theme, industrials. Then there's the S&P and the Qs, aggregate bond index, the tech sector, US dollar, and the semiconductors. So as it relates to where we're positioned, our biggest weight continues to be financials. Financials are contributing great earnings growth, great dividend growth, low volatility, and they continue to be under-owned. We own insurance, banks, regional banks, and card companies. Energy is now 16% of the portfolio, and the reason we're there is very significant cash flow generation and dividend growth. Both of these sectors are sectors that do well in the face of an inflationary environment. Our industrial weight's been pretty constant at around 10%. Materials has been rising. It's almost 9%, and that's made up of gold and uranium. The communications sector is about a sector weight, but it's because we own the platform companies, not the telecom stocks. Tech continues to be an underweight. It's not to say that we can't add weight back if we start to see the group lift, but at this point, whether it's consolidating or correcting, it's underperforming. And we think very broadly owned, which means that people could look to reduce their exposure here. At the defensive end of the spectrum, utilities, government bonds, cash, real estate, and healthcare continues to be a relatively low weight, although we are looking to increase our weight in the healthcare sector, specifically in the device companies. I put this up a couple of times since last fall, but it's something that we don't ever want to forget. Yes, there's news flow, but the most important thing that drives asset prices is liquidity. Liquidity and earnings. So far in this quarter, we were expected to see 8% earnings growth in the S&P. It's coming in closer to 12. That would make it the best quarter we've seen, going all the way back to the first quarter of 2022. If we see improving liquidity, and the Fed has said they're going to stop running off their bond holdings in the market, or QT, and if we see earnings growth, and if we see conditions for US and global businesses improving, share prices can move higher despite news flow. We watch the credit spreads for signs that bond investors are getting nervous, but spreads continue to compress. We look at levels of volatility to see if big investors are starting to hedge themselves with options, which sometimes can cause volatility to spike. Volatility historically during bull markets is fairly muted. And as it is right now, we're sitting right here in the midpoint, actually below the midpoint of the range. So look, Don't be afraid of a bull market. Don't be afraid of a quiet market. Let the market be the evidence. Okay, we're going to read lots of news flow over the next 4 years. Some of it's meant for shock value. But we've got to have process to make the decisions. And so long as breadth is supportive in the market, so long as there are clear leadership themes, so long as there are companies that are meeting and exceeding expectations and trading favorably, then we're going to be invested. This can go on a long time. When you got 2 years off a market low, the average length of a bull market was 5.5 years. So we're 2 years off that low, 2 years and a bit. It may be we're going to have up and down months over the course of this year. Last year was a great year. Maybe the market's going to churn a bit. But we think that there's lots of opportunities in this market, and we will get defensive if it gets more difficult. But just because we have recent years that were negative, remember, you can go long periods of time without negatives. So we've had a great year in 24, a good year in 23. This can carry on. Things get more difficult, we can get more defensive. But as it stands right now, I think the positions are hanging in pretty well. So with that, let me see if there's any questions. Let me go to the list here. David, copper prices move sharply higher, but the stocks barely respond. Is this due to tariff possibilities? Yeah, Steve, I think that there's a couple of things here. The stock that's responded best is Hudbay Mining. Freeport has been slow to respond. Teck has been slow to respond. I think that there are some concerns about tariffs. Certainly, the tariffs on aluminum and steel aren't helpful. But if copper prices move higher and profitability is there, it's a global product. I would expect to see the miners move higher. I have something from Stephen. What are the primary drivers of income funds year-to-date performance? I would say that the primary driver is financials. It continues to be a portfolio that's aimed at dividend growth. So when the market wobbles, it has a little impact. Dividend growth as a theme tends to have half as much volatility as the market with all of the returns. We've not been focusing on fixed income. I think there's no fixed income in the portfolio. In our balanced fund, we do have to have a minimum of 30%, and that 30% is in an average maturity of about 3 years, and it's corporate bonds. I think the average yield is something like 5.5%. But dividend growth is the theme. We're really not focused on the high dividend payers, which, if the market got more difficult, would be probably more stable. But there's no sign of that at this point. So we're going to continue to focus on dividend growth. I think that if you look at it, our average position is trading at about 17 times earnings. The S&P is at 22. So our holdings are much cheaper than the market. And the dividend growth, last I checked early this week, is now over 15% over the past year. And that's versus, I think, 7% dividend growth for the S&P. So that would be the core characteristic. John Nickel is asking what Barometer's percentage holdings are in Canada, the US, and global. So in a client portfolio in general, we're holding between a 5 and 10% weight in our global fund, which is all ex North America, meaning not Canada, not US. It's actually up about 9% year to date. It's having a great year. In the split between Canada and the US, we lean to the US currently, although we do have weightings in Canada in energy and materials. So the holdings themselves are sort of like 60% US, 40 in North American portfolio. But as it is right now in our funds, we have hedged back to Canadian dollars, which is a change. We think that we may have seen a crescendo in selling in the Canadian dollar. The Canadian dollar bottomed at the same price it bottomed at in the COVID low in 2020 and at the worst point of the sell-off in 2015. And we think actually the weight of evidence could be the Canadian dollar could strengthen from here with political change. So that's a bit of a roundabout answer, but I think that would give you pretty much what you need to know. I don't have any more questions. So we're on the backside of earnings. We've got 3 more weeks. This week there's fewer earnings than last week. Last week was the biggest week. If the earnings beats continue to come in, we think that that's a positive. Looking forward to Q1 earnings, Q2 earnings, and Q3 earnings. It is a market where there are companies being rewarded, but there are companies being punished for missing. So it's a market that is not acting all together. It's a sorting hat. There's strong companies and weak companies, and we really think you do have to pick your spots. I think this year could be a really important year for active management, especially if tech and the Mag 7 continues to underperform. It's a big part of the S&P, and there's an opportunity to outperform in some of the smaller sectors like energy and materials. So we'll see. With that, thanks very much for tuning in. We'll do it again next week. Tried to keep it a little bit shorter today. We'll see if there's any sort of key themes that we can focus on next week. If there's things that we haven't answered, please reach out. We're happy to have a conversation with you. If you'd like to set up a review, let us know. I know Tiffany and Siobhan have been working through setting up meetings with everybody, and we're happy to jump in between. Have a great week, folks.